FAC1601 Notes Reading. Learning Unit 1. Introduction to the Preparation of Financial Statements. FAC1601 concerns itself with the issues of accounting reporting for different entities and builds on the learning outcomes of FAC1502. You will remember that the following topics were covered in FAC1502 as follows. Basic principles of accounting, including the nature of accounting, financial position and performance, double entry and the accounting process. Collecting and processing accounting data, including the processing of data and adjustments, closing off procedures, and preparing financial statements. Accounting for current and non-current assets, including cash and cash equivalents, trade and other receivables, inventory, property, plant and equipment and other non-current assets. Accounting for current and non-current liabilities. Accounting reporting, including the financial statements of a sole proprietor, non-profit entities, and incomplete records. FAC1502 taught the basic bookkeeping functions and introduced you to the concepts, principles, and procedures of accounting. It is important to realize that FAC1502 forms the foundation for all other financial accounting modules. The knowledge that you gained in FAC1502 forms the building block of this module and cannot be repeated. If you need to refresh your memory on these topics, please refer to the FAC1502 study guide and other supplementary learning material for that module. Introduction. In FAC1502, we learned that every business entity usually uses some accounting system to collect financial data from a multitude of financial transactions. The entity then uses the data and processed information about the entity's financial performance and financial position to present the information in a usable format, for example, financial statements and budgets, that will assist the users to make economically viable decisions. Remember that the accounting system covered in FAC1502 forms the foundation for reporting the information to users. In the introduction to this learning unit, we will briefly explain the regulatory framework applicable to financial reporting in South Africa and give you an overview of why financial statements must comply with certain requirements and who is responsible for issuing and overseeing compliance with the regulatory framework. To have financial information available that is meaningful and comparable across different types of entities in countries around the world, the quest became to develop a set of prescriptive standards that will provide guidance and prescribe certain principles that can be used to prepare financial statements. Most countries established governing bodies with a mandate to develop these standards. One of the many governing bodies mandated to embark on this quest was the Accounting Practices Board, APB, which was established in South Africa in 1973. The APB issued accounting standards that were collectively known as South African Statements of Generally Accepted Accounting Practice or SA-GAAP. All listed and unlisted companies in South Africa were required to use SA-GAAP as their reporting framework when preparing financial statements. In the 1990s, the APB decided to incorporate South Africa into the International Accounting Standards arena and to harmonize SA-GAAP with the standards issued by the International Accounting Standards Board, IASB, and its predecessor, which issued International Accounting Standards, IASs, from 1973 until 2001, when the IASB was established. These IASs are now designated as part of International Financial Reporting Standards, IFRS, as these international standards are currently called. As from January 2005, the Johannesburg Stock Exchange, JSE, requires all listed companies to comply with IFRS. The Companies Act 71 of 2008 that came into effect in May 2011 established a body known as the Financial Reporting Standards Council, FRSC, which is now the South African Governmental Accounting Standard Setting Body. The South African Institute of Chartered Accountants, SACA, serves as the technical advisor to the FRSC. Because of the high regard of the usefulness of these standards to prepare financial statements that are usable and comparable across countries, it became common practice to apply these statements, either in full or to a limited extent, when preparing the financial statements of entities other than companies. IFRS deal with identification, recognition, measurement, presentation and disclosure requirements in general-purpose financial statements. These financial standards are directed at a wide range of users such as investors, shareholders, creditors, banks, the South Africa Revenue Service, SARS, employees, and other interest parties. There are currently two reporting frameworks available, namely full IFRS or IFRS, for SMEs. FAC1602 introduced you to the conceptual framework, which is the starting point of this learning unit. Conceptual Framework for Financial Reporting. 1.2.1 Introduction. The Conceptual Framework for Financial Reporting was issued by the International Accounting Standards Board, IASB. This document contains a group of interrelated rules and standards that serve as a frame of reference for financial accounting, and more specifically, financial reporting. These rules and standards set out the nature, function, and limits of financial accounting and financial statements. The purpose of the conceptual framework is to assist the International Accounting Standards and financial statements Board, IASB, in developing and revising international financial reporting standards, IFRS, that are based on consistent concepts, to assist preparers to develop consistent accounting policies for areas that are not covered by a standard or where there is choice of accounting policy, and to assist all parties to understand and interpret IFRS. The framework is not an IFRS and does not override any specific IFRS requirement. The framework is simply a foundation on which all the international accounting and financial reporting standards are based. Should the IASB decide to issue a new or revised pronouncement that is in conflict with the framework, the IASB will highlight the fact and explain the reasons for the departure and the basis for conclusions. Activity 1.1. Describe in your own words what you perceive a framework to be. B. Describe the purpose of the conceptual framework. Would you say that the conceptual framework is similar to an IFRS? 1.2.2 Objective of General Purpose Financial Reporting. The objective of general purpose reporting is to provide financial information about the reporting entity that is useful to existing and potential investors, lenders, government agencies, South African Revenue Services, Statistics South Africa, etc., and other creditors in making decisions about providing resources to the entity. These decisions involve buying, selling, or holding equity and debt instruments, and providing or settling loans and other forms of credit. Potential and existing investors are interested in the returns they expect, while creditors and other lenders are interested in principal repayments and interest payments they expect. Activity 1.2. Who do you think are the users of financial statements? Name a few. 1.2.3 Qualitative Characteristics of Useful Financial Information. If external decision-makers are to be able to use the information contained in the financial statements, these statements should possess certain qualitative characteristics. 1.2.3.1 Fundamental Qualitative Characteristics. The two fundamental qualitative characteristics are relevance. The information provided must be relevant to the user of that financial information. Relevance implies usefulness. The user must be able to make relevant decisions on the basis of the information supplied in the financial statements. Materiality. Materiality is noted as an entity-specific aspect of relevance and is used to decide what information would be relevant to users. Information is deemed to be material if it is likely to influence the decision of the user of financial information. Faithful representation. Information presented in the financial statements should faithfully represent the transaction and events that occurred during the reporting period. Faithful representation requires that transactions and events be accounted for in a manner that represent their true economic substance rather than the mere legal form. This concept is known as substance over form. The rationale behind this is that financial information contained in the financial statements should represent the business essence of transactions and events, and not merely their legal aspects in order to present a true and fair view. Substance over form requires that if the substance of a transaction differs from its legal form, such transaction should be accounted for in accordance with its substance and economic reality. For example, a machine is leased to the entity for the entire duration of its useful life. Although the entity is not the legal owner of the machine, it may be recognized as an asset in its financial information since the entity has control over the economic benefits that would be derived from the use of the asset for the duration of its useful life. The legal form of the transaction is that the title deed of the asset is with the original owner, lessor, even though control of the asset has been passed to the entity, lessee. This is the application of the accounting concept of substance over legal form, where economic substance of a transaction takes precedence over its legal aspects. Faithful representation is achieved when the financial information is complete, neutral, and free from error. Completeness means disclosure of all information necessary for proper understanding of the presented financial information. Neutrality requires an unbiased depiction of financial information, meaning that such information may not be manipulated to influence the behavior of the users of the information, either favorably or unfavorably. Free from error means there are no errors and inaccuracies in the description of the phenomenon and no errors made in the process by which the financial information was produced, no inaccuracies and omissions. The standards expect that the estimates are made on a realistic basis and not arbitrarily. 1.2.3.2 Enhancing qualitative characteristics. Comparability. Comparability is a qualitative characteristic that enables users to identify and understand similarities in and differences between items. Information about a reporting entity is more useful if it can be compared with similar information about other entities, with similar information about other entities, and with similar information about the same entity for another period or date. Consistency is not the same as comparability but is an important element that assists to achieve comparability. Consistency refers to the use of the same methods for the same items either from period to period within a reporting entity or in a single period across entities. Users must be able to distinguish between different accounting policies in order to be able to make a valid comparison of similar items in the accounts of different entities. Verifiability. An entity's accounting results are verifiable when they are reproducible, so that, given the same data and assumptions, an independent observer can produce the same result on the same set of accounting information. Verifiability means that different knowledgeable and observers could reach consensus that a particular depiction is a faithful representation. Timeliness. The timeliness of accounting information refers to the provision of information to users in time for them to take action. Information becomes obsolete and useless if it is not reported within time. Understandability. Classifying, characterizing and presenting information clearly and concisely makes it understandable. Understandability implies that an entity's financial information should be presented in such a way that a person with a reasonable knowledge of business and finance, and the willingness to study the information, should be able to comprehend it. The cost constraints on useful financial reporting. A cost constraint arises when it is excessively expensive to report certain information in the financial statements. When it is too expensive to do so, the framework, Conceptual Framework, 2.39 to 2.40, allows a reporting entity to avoid the related reporting. The objective of allowing the cost constraint is to ensure that the benefits of providing financial information outweigh the costs as part of their financial reporting obligations. You must be able to explain in your own words what each qualitative characteristic entails. Activity 1.3. F. Name the fundamental and enhancing qualitative characteristics of financial reporting, as stipulated in the conceptual framework. B. Should one report all the matters irrespective of the cost of reporting? 1.2.4 Financial statements and reporting entity. Financial statements provide information about economic resources of the reporting entity, claims against the entity, and changes in those resources and claims that meet the definitions. Of the elements of financial statements, Conceptual Framework 3.1. 1.2.4.1 Objective and scope of financial statements. The objective of financial statements is to provide information about an entity's assets, liabilities, equity, income, and expenses that is useful to financial statements users in assessing the prospects for future net cash inflows to the entity and in assessing management's stewardship of the entity's resources. Conceptual Framework 3.2. This information is provided in the Statement of Financial Position and the Statement of Profit or Loss and other comprehensive income, as well as in other statements and notes. Conceptual Framework 3.3. 1.2.4.2 Reporting Period. Financial statements are prepared for a specified period of time, usually a year, and provide comparative information for at least one preceding year, and under certain circumstances, forward-looking information. Conceptual Framework 3.4 to 3.6. 1.2.4.3 Going Concern Assumption. Financial statements provide information about transactions and other events viewed from the perspective of the reporting entity as a whole and are normally prepared on the assumption that the reporting entity is a going concern and will continue in operation for the foreseeable future. Conceptual Framework 3.8 to 3.9. 1.2.4. For the reporting entity. A reporting entity is an entity that is required, or chooses, to prepare financial statements. It can be a single entity or a portion of an entity or can comprise more than one entity. A reporting entity is not necessarily a legal entity. Conceptual Framework 3.10. Determining the appropriate boundary of a reporting entity is driven by the information needs of the primary users of the reporting entity's financial statements. Conceptual Framework 3.13 to 3.14. Each financial statement must clearly mention the name and type of reporting entity to which it pertains in its heading. That's the end. Thank you for watching. In the next video, we will be covering 1.2.5, the elements of financial accounting.